Hello, everyone. Dear students, can you please confirm me? Am I clearly audible and visible to all of you? Can you please confirm me? Am I clearly audible and visible to all of you? Great. Okay, dear students, I welcome you all in today's live session, day three of AAA, Advanced Audit and Assurance Exam Focused Revision Series. I hope and I pray that every one of you is doing great and every one of you is preparing your heart out for this all important paper, your qualification desired, advanced audit and assurance. Okay, so we have been revising the concepts, AAA concepts in the last two sessions, and we'll be continuing our revision. And we'll also be looking at a few exam focused questions in today's session. So first of all, we'll continue our discussion where we left tomorrow. Okay. We had a discussion about the planning phase of the audit, risk assessment, specifically business risk. When we are planning the engagement, we need to obtain the understanding of the entity, and that understanding of the entity enable us to identify business risks. What are the business risks? The risks which are associated with the business. In the first place, they have nothing to do with the financial statement. In the first place, we have to think as if we are the CEO of the company. In the first place, we have to think as if we are the owners of the company, and we have to think for the risks facing the businesses, the risks which are being faced by the business. In the very next phase, once we are successfully able to identify the business risks, our next objective will be to link those business risks with the financial statements. Okay. We also had a look at the business risk technique, exam focus technique. We discussed about materiality. We discussed about benchmarks. We discussed about risk assessment, business risk. We discussed about the examples, few examples of business risk, marking a scheme of business risks. Then we also discussed what are analytical procedures, how to link it with the scenarios. Then we discussed the exam technique of risk of material misstatement. And here, just when we reached here, because I was very tired yesterday, so I requested that we will do the onwards discussion tomorrow. Okay. Very important discussion. Risk of material misstatement. Very important exam technique. Very, very important. 6-step exam technique. Now, what is risk of material misstatement? Financial statement risks. I discussed that audit risk model. It has three components: inherent risk, control risk, and detection risk. And inherent and control risk together called risk of material misstatements. Okay. So very important. The exam technique. Very first step, materiality. Materiality calculation has few very easy numbers which you can pick uh, quickly in your answers. Plus, now examiner is prescribing the materiality benchmark. So it's comparatively easier for you. You know the benchmark percentages, and you can calculate materiality. Okay. Then you have to identify that which financial statement area is under the risk. Which financial statement area is under the risk? For example, is it inventory? Is it intangible? Is it financial instruments? Which area? Which financial statement area? So by simply identifying the area, you can score half a mark. Plus, you also have to explain that how. Does it have risk of overstatement, wrong valuation, wrong classification? Okay. It's good if you can identify the risk type as well. And I told you that 90% of in 90% of the cases, you'll be facing inherent risk. Okay. Then you have to state the required accounting treatment. Now, this is the area particularly where the students lack uh, the knowledge, plus they also lack the application of the accounting standards. They fail to link the proper accounting standard with the risk. Here they lose two very easy marks. Then you have to write why you feel there is a risk. You have stated the correct accounting treatment, but you also have to apply it on the scenario. We'll see how. Then you have to use analytical procedures if any numbers are given, and risk impact, another important element. Is it the risk of understatement, risk of overstatement, under disclosure? Whatever the risk impact is, you have to mention the risk impact as well. Marking scheme. For materiality calculation, you have few marks allocated. For example, there's a capping of 3 marks. For example, 3 marks. 3 marks are there for materiality. 1 mark is there for identifying the risk and impact in the relevant area. For that simply means that half mark is for identifying the FS area, and half mark is for the impact. 1 mark is for relevant accounting treatment applied. That simply means that half mark is for the treatment, and 0.5 marks for the application. Additional half a mark for the analysis or evaluation if you can find additional comment to evaluate as per the numbers given. Professional skill marks, obviously, professional skill marks for professional skepticism are also here because obviously you are critically thinking of the scenario, you are critically analyzing the information, and you are identifying it as an audit risk. Professional skepticism and judgment. Then, if you are making use of numbers in your answers, it simply means that you are also picking up important marks available for analysis and evaluation. Okay. Dear students, can you please confirm me that am I clearly audible and visible? Because I cannot see my mic blinking. So, perfect. Okay. So professional skill marks. Professional skill marks are those marks which will flow in your kitty if you follow the exam technique. If you follow the exam technique, okay? Okay. And I also told you that, for example, materiality calculation, audit risk part, for example, if it's a 24-mark part, then materiality calculation, usually the materiality calculation is of 3 marks, capping of 3 marks, okay? And since now the examiner has prescribed the benchmark, so 1 mark will be for justifying your overall materiality. And in whichever risk you make the comment relating to materiality, in whichever audit risk you will link it with the materiality, you will be getting 0.5 mark. So, for example, 1 mark for justification of your overall materiality and 2 additional marks. Okay. Then risk, impact, accounting treatment, and application. 0.5, 0.5, 0.5, and 0.5. So if you can identify these 4 elements, if you can explain, if you can identify, if you can draft a risk, keeping in view these 4 elements, it simply means that you can easily score 2 marks in that risk. Materiality mark will be 0.5 or 1 mark. But after the change in schema, where now the examiner is prescribing the benchmark, where the examiner is prescribing the benchmark, it's not a very detailed comment. It's a very simple comment. It's a very simple comment. Now, you do not have to analyze the materiality with respect to variety of benchmarks, because now the examiner has prescribed you the benchmark. Okay. So 2 marks, 2.5 mark. If the examiner awards you 1 mark for materiality, that becomes 3. So in one audit risk, you can score maximum of 3 marks. In one audit risk, you can score maximum of 3 marks. Once again, I'm repeating, 3 mark. And specifically, if you identify a relevant trend calculation, you can score 0.5 mark more. Okay. So this is the marking scheme of audit risk. Let me repeat once again. So how can you score the maximum in one audit risk? How can you make one audit risk juiciest? Not juicier, juiciest. How can you make it the juiciest risk? You can simply make it juiciest by ensuring that all the elements have been discussed in your drafted audit risk. Although we have discussed these examples yesterday, but I would reread those risks and rediscuss a few of those. For example, you have to look at this. Receivables. A major customer is struggling to pay their debt, and as a result, the receivable balance is significantly higher than last year. Now, this is the information which is given to you in the question. You have picked it and you have rightly identified it as the risk indicator. Okay. Now, materiality. The balance outstanding represents 5% of total assets, therefore is material to the financial statements. Since examiner has prescribed you the benchmark, you can use that benchmark to assess the significance. Okay. Then, moving further, after materiality, you are now linking the problem. You are also identifying the financial statement area. What is that area? Receivable. The receivable balance. The receivable balance. You already identified the receivable balance. The receivable balance. Okay. Now you are identifying the relevant accounting treatment in accordance with IFRS 9 financial instruments. Okay. You do not need to mention the accounting number if you don't recall it properly. You can simply say as per the relevant accounting standard, as per the relevant accounting standard. Okay. A receivable balance, a receivable should be measured. A receivable should be measured at transaction price less allowance for any expected credit losses. Well, this is the relevant accounting treatment which is applicable here as per the risk which you have identified. Next step. Next step. What's the problem? There is a risk. Where is the risk? In the receivables. We have already mentioned. not only in the receivables, but also in the profits. How? They are overstated. Now, this is an impact. This is the risk impact. Overstated. Overstated. So, see, the materiality, identification of area, identification of area, accounting treatment, risk impact, application of accounting treatment. Application of accounting treatment. All the elements will make this risk a perfectly drafted risk. Let me repeat it once again. Area which is under the risk, materiality, financial reporting standards requirement, a requirement of accounting standard, risk impact, and the application of the accounting standard. We have written the relevant accounting standard, and now we are applying it as well. That the problem persists if this accounting standard is not applied, if this is not followed, if the debt is not written off, if the debt is not written down. Simple. So we'll mention the relevant accounting treatment. For example, a question will come where the director will say that these are the cash settled share based payment, and we are not required to even book the expense in P&L. So you will mention the relevant accounting treatment of the accounting standard, and you will say that this is the problem, this will be overstated, this will be understated. If the requirement is not followed, that is, the expense has not been recognized and the liability has not been recorded. And the liability has not been repriced at every year end because it's cash settled share based payment. So you have to apply it as well. Mentioning the accounting treatment is not enough because you have to apply it as per the situation given to you in the question, as per the scenario, as per the comments of the directors. Are you getting this? I hope I'm making this crystal clear to all of you. Let's have a look at another risk. Foreign currency transaction. The company purchases all goods from an overseas supplier, resulting in a foreign currency. So this is an information in the question. This is the information given in the question, which is creating the risk. So first of all, you've identified this. Now, this is the relevant accounting treatment in accordance with IS 21. If you don't recall the standard, don't mention the accounting standard number. Simply say, as per the relevant accounting standards. As per the relevant accounting standard. Simple. Mention the accounting requirement. As per the accounting standard, foreign currency purchases should be translated using a spot rate or average rate at the date of transaction. Date of transaction, you should use spot or average rate. And if there's any monetary balance as a year end, foreign currency monetary balance, it needs to be repriced at every, revalued at every year end. Accounting requirement, done and dusted. Then we'll say there is a risk that purchases, risk area. Problem where it is, the purchases are misstated. Could be undervalued, could be understated, could be overstated. So we use the word misstated, risk impact. If the exchange rate used is incorrect, application of the accounting standards. If you fail to follow the requirement, if you fail to opt for the appropriate exchange rates, these numbers will be misstated. When translating purchase cost. So you are applying the standard here in this sentence. If the exchange rates are not properly used when translating the purchase cost, you are applying you are applying the requirement of accounting standard and linking it with the scenario. Plus, it's not done yet. Sorry. Payables may be misstated as well if they have not been revaluated yet. Everything. Purchases may be misstated. Payables may be misstated if they have not been revaluated yet. Mention all possible impacts and your risk is complete. Are you getting this? These are the two risks appearing on your screen. So please go through both of these. Please go through on your own. At the time, let me have some cookies by the time you are reading this. So here, see in this risk, for example, the numbers are not given. If the numbers are not mentioned, if the numbers are not given, you cannot link it with the materiality. Simple. So you cannot score the marks for materiality in that risk. Simple. But can you score the other two marks for financial statement area, risk impact, accounting standard, requirement, and application? 0.5 for all the four areas. Can you score this? Yes. Now see, during the year, the company introduced a cash settled share based payment, but no amounts have been recognized in the financial statement. So you've identified the relevant information. In accordance with IFRS 2, share based payment, the liability in respect of plan should be measured at fair value at the year end. Simple. You identified the accounting requirement. So what will happen? Expenses, the relevant expense, and the liability. Okay, so you've identified the area are understated. You identified the risk impact that these may be understated. If no amounts are recognized in respect of these key, you have applied the accounting treatment. Simple. So it's not necessary to write bulk of answer to score the mark. If you are on target, if you are on point, you can still score maximum marks. Okay. Okay. Another thing, there are a few risks for which the examiner gives you a lot of information. Apparently, you will think as if it is one risk, but there will be multiple elements of the risk you can extract from that information. For example, suppose if there is a question relating to discontinued operations IFRS 5, there may be a possibility that examiner may also give you the information relating to discontinued operation, impairment of assets, and multiple other elements, which makes that point very strengthened, very juicy, and you can link it with multiple standards and risks. In those special cases where the examiner has given you a lot of information for any particular item, there may be 5 marks, 4 marks, 5 marks available for that risk if you explain it from all the parameters, all the facets, all the aspects. Okay. Yes, Curly. IFRS 15, we will be, I think when we'll be practicing the question, IFRS 15 elements will be coming in. Okay, so don't worry about that. Okay, read this one as well, not the financial instruments. One more, read this one as well. So you came across the information that during the year the company purchased shares worth $200,000, which have a fair value at the reporting date of $250,000. And the difference is $50,000. Okay. So unfortunately, my mouse has stopped working. If you can allow me a minute. Mhm. So during the year, the company purchased. Am I audible to you now? I hope I am audible now. Please confirm. Great. So during the year, the company purchased shares worth $200,000, costing $200,000, having the fair value at the reporting date of $250,000. This difference of $50,000 represents 1.5% of total assets, which is material. Okay. So what we have done, we have identified the area, we've identified the misstatement, and we have calculated the materiality. Now, relevant accounting treatment. In accordance with IFRS 9, shares should be measured at fair value through a statement of profit and loss unless a designation is made to measure at fair value through OCI. So the gain should go in P&L unless we have designated on initial recognition fair value through OCI. We know this requirement. Okay. So what has happened? The shares should be valued at the share price at the reporting date, and any increase or decrease in the value should be taken either to statement of profit and loss or OCI. The shares are valued at cost in the statement of financial position, which is wrong. Either they should be valued and the gain should either go in P&L, either go in OCI. They shouldn't be carried out at cost. Okay? The shares are valued at cost. So this is the problem. So see, here you are applying the accounting treatment, on the information given to you, on the problem which has been mentioned in the question. Simple. So you know the accounting treatment and you can apply it. This is wrong. They shouldn't be valued at cost. They should be valued at the market value. With the gain either going to P&L, either going to OCI. But no carrying out at cost. Okay, the shares should be valued at the shares are valued at cost in the financial statement of financial position, which means investment is understated by $50,000. And not only statement, what are the areas? See, you have to identify all the relevant areas, investment as well, and corresponding profit or OCI. Both are understated. Both are understated. So you have to mention all the possible impacts. It's not just that you only mention this about the investments. You know, if they have any P&L impacts, do also mention those impacts. Are you getting this? See, another one, government grant. Read this as well, because government grant is also a commonly tested audit risk. So please do read this as well. See, the government grant represents 5% of total assets in the material to the financial statements. You got marks for materiality. Then, in accordance, in accordance with IS 20. Okay. Apologies, but can you please confirm me that you can see this pointer on the screen? This pointer moving? Please confirm me that you can you see my pointer moving on the screen? Perfect. Thank you so much. Thank you so much. Okay. In accordance with the IAS 20, accounting for government grants, relevant accounting standard. I have seen many students mentioning the wrong accounting number. If you are not sure, avoid writing standard number. Okay. The grant should be recognized as income over the period necessary to match the grant received with the related costs for which they are intended to compensate. Easy requirement. The amount not recognized as income this year should be deferred to the statement of financial and released to profit on systematic basis. For example, you have received a grant which is against the expenses, and the expenses have not yet been income. So obviously, you cannot recognize the income completely. We have to defer it for the portion against which expenses needs to be incurred in future. Simple. There is a risk. What is the risk? The grant has been recognized in full. Income. Grant has been recognized in full, leading to overstatement of income and profit, both the elements, and understatement of deferred income, balance sheet item. So accounting, requirement, application, area, risk impact. Is everyone crystal clear or not? Please let me know. Audit risk, financial statement risk. We should be very crystal clear about how to draft the audit risk. Is this crystal clear to everyone? You should at least know the scheme before we move on to practice the question. So please confirm me. If you have any confusion, please do ask. Let me know if you have any problem anywhere. Then these are the simple areas you can go through on your own, as I discussed yesterday as well. Assessing whether the risk is significant. Okay. Exam question specifically asks to prioritize significant risks. Significance of the risk uh, is reflected from the amount involved. Okay. Quantum, amount involved. But this is not necessary that only those risks are significant which involve high amounts. There are such risks which even may not be monetarily material, but they will be significant. And which are those risks? These. If it's a risk of fraud, even if it's a smaller one, but it will be a significant risk. A risk relating to economic other accounting developments, new developments, complexity of transaction, related party transaction, subjectivity involved. If the transaction is outside the normal course of business. Okay. So these will be these factors make the risk significant. Okay. Okay. Then what will be your responses to the assessed risk? If you have assessed that there's a risk, what's the next step? Okay. If I know there is a risk in a particular area, for example, non-current assets, for example, inventories, for example, financial instruments, obviously I'll try to target that area more, isn't it? I'll then design audit procedures. I'll then devote more attention, more energy, more staff, more time. So I'll be professionally skeptic. I'll be more concerned about that. I'll try to test it more. I'll try to think more about it. I'll try to corroborate more with other evidences. I'll try to assign experienced staff, more supervision, element of unpredictability. Because if I know that my procedures are very uniform year by year, and client knows what I'm trying to do, so they might commit a fraud which bypass my usual procedure. So what I can do, I can incorporate element of unpredictability. I can perform some other procedure, some other technique which the client doesn't know. And that technique may uncover any fraud. Okay. For example, just to give you an example, for example, if I carry out, one of my teams carry out cash count always at end of the year, 31st of December or 30th of June, then client may keep their cash unreconciled and may pass the fake entries to reconcile at year end. So why not to do some surprise cash count? Why not to do some surprise inventory count? Okay. So if the controls are not strong, we will be inclined to do more substantive testing. Now, there are two types of substantive testing: test of details as well as analytical procedures. Okay. Professional skepticism, we've already discussed these two lists yesterday. What are two lists? Okay, audit evidence is an audit procedure. This is the area where students tend to struggle the most. Students tend to struggle the most. What are these areas? Audit evidences, audit procedures. Okay. Well, I'll not regard these as two areas, one area. One area. This is one of the area where the students struggle the most. And this audit procedure drafting, audit evidence drafting, this is not only important when you are doing an audit question number one, but audit procedures are required or asked even in non-audit assignments. Okay. So technique remains the same. Technique for thinking of the audit procedure and for drafting of the audit procedure remains the same. Be it an audit assignment or be it a non-audit assignment. Technique will not change. Approach will not change. And you might not need to learn all the procedures. You should learn the technique to think of a procedure. Okay. Rote learning all the possible procedures and simply uh, mentioning on your exam will not do the trick because examiner is very focused that which area you need to test, which assertion you need to test. So sometimes you have to think as per the given situation. Your already learned procedures will not be very relevant to the given question. Are you getting this? So you should learn the art that in which situation are you performing which procedure. And there are not many. There are few. And those few procedures will be applicable all the time. Okay. Those few procedures will be applicable all the time. Yes. You can read and reread those procedures which are frequently tested. I'm not saying no. You can read, reread, and obviously you can keep those in your mind so that the quality of your drafting improves. But rote learning a set of procedures, with just vomiting those procedures wherever you want to, will not do the trick, will not earn marks. This is what I've observed. This is what I've observed in the mock exams. It seems that students have learned a set of procedures and they are trying to just throw wherever the procedures are needed. No, don't do this. Link it with the scenario, link it with the question, link it with the information in the scenario. Okay? Learn the art and do the art in the examination. Getting? So there is a question which comes up in the examination. What audit procedures to test? Either the examiner will readily give you the question, which audit procedures to test. Identify the audit procedures. Simple. Other type of question. Matters to consider and evidence which you should find on the audit file. Okay, matters to consider. Now, this is an element which I'll be discussing just shortly. But this one, I emphasized this yesterday, but since I was very tired and I was feeling sleepy, so I believe that I was not able to focus on this much. Okay. Here's two things. It seems that these are two different things, but these are not very different. And the example is in front of you. Procedure. Inspecting sales agreement. Usually start from the verb. Inspect the sales agreement to verify. And why are you doing this? This is particularly important. That why are you performing any procedure? If you are drafting a procedure and you are not mentioning objective, you will not be fetching maximum marks. Okay. What are you doing? Mention the verb. We usually start from a verb. What are you inspecting? Source. Purpose. Third element. Okay. So let me use different colors so that although you understood what I'm trying to say, inspect, sales agreement, and this is the objective. So in 80% or 90, even 90% of the procedures, you can simply find out these three. Action, source, purpose. An examiner is given a technical article on drafting audit procedures. You can read that. That's a very good article. Yes, there are inquiries where you might not find any source. Okay. But the inquiry related procedures are also very similar. So if you can read those, if you can have an idea of those procedures, you can write those procedures as well. No worries. Okay. But if the question asks you what evidence you will be looking in the audit working paper file, don't worry. Similar methodology. But here you are not starting the sentence with any action. Evidence. Okay. In the file, I'll be looking for a copy of sales agreement. Okay. Why? So that I can verify the date proceeds in name of the buyer. Simple. A working showing recalculation of the depreciation. Two, ensure the accuracy of the valuation of assets. Valuation of assets. Okay. So that's not a big deal. Important thing, action, source, purpose. Then financial statement assertions. Obviously, you know that procedures are targeted for an assertion. Procedures that do target a particular assertion. For example, you are auditing a disclosure. A disclosure has not been prepared properly. So, which assertion is it impacted? Presentation assertion. Revenue expenditure might have been capitalized. Capital expenditures might have been expensed out. Which assertion? Classification assertion. Inventory cost might not have been properly recorded. Cost of inventory, accuracy, valuation. Assets might not have been completely recorded. What is the test of completeness? Simple. You pick an asset, a physical asset, trace it back to the fixed asset register. Pick a random asset. Look at the register. Is it there or not? Inventory counting. Look at inventory, floor to sheet, tallied from floor to sheet. Financial instruments for investments. Have a confirmation from the authority. For example, if there are treasury bills, have the confirmation of treasury bills, and then look at the record of the entity. Is it appearing or not? Completeness. What is the test of existence? The test of existence. Look at the list of the entity, list given by the entity, be it fixed asset register, be it the list of investments, and then pick that element, pick that asset, and then try to verify it physically. That's a reverse mechanism. Okay. Rights and obligation, ownership, title deed. So these are account balances assertion, transactional and events assertion, the transactions being carried out for the year, occurrence, completeness, accuracy, cutoff. So not a very difficult discussion, and you already know this. This is fairly simple. You can go through on your own. These two lists we discussed yesterday, audit procedures and audit. So you need to keep these two mnemonics in your mind. If you can keep these in your mind, it will become easier for you to think of the procedures and to think of the evidences. Very simple. This is the list to recall the procedures, and this is the list to recall the evidences. And as I told you, that these two things are not very different. These two things are very similar. So if you recall audit procedure list, you can even think for the audit evidence. And if you can recall audit evidence list, you can also think of the audit procedures. So both of these lists are friendly lists. They both are friends, in fact, siblings. The first list is AEIOU, analytical procedures, inquiry, confirmation, inspection, observation, recalculation. So you will be starting your procedures, analytical procedures, perform, analytical procedures, perform, comparison. Okay. Perform comparison of gross profit margin, cost margins, whatever. Okay. Comparing with the industry trends, with which, why you are comparing. Okay. Inquiry, confirmation, inquiry from the management personnel. You will be doing lots of inquiries. Confirmation is also an inquiry, but from a third party outside the entity. Receivable confirmation, payable confirmation, legal confirmation, tax confirmation, bank confirmation. Confirmation, it's also an inquiry. But can you think of the audit evidence? Yes, the confirmation, physical confirmation. It's an evidence. Inspection of documents. Yes, it's a procedure. Well, what's the evidence? The document being inspected, the invoice, the title deed, the valuation report. Observation, you are observing a process of reconciliation. Recalculation. You are recalculating the depreciation. You are recalculating the interest charge. Okay. You are recalculating the impairment working, the value and use working. Okay, that's an audit procedure. But what's the audit evidence? What's the audit evidence? The copy of working is the audit evidence. And what will you be checking in that working? Recalculation. And you will also be looking at the reasonableness of the rates. Okay. Audit evidences. SAD 3. And it's A2 and B2. That's for subsequent events. Okay, subsequent events also give you evidence, as I told you. NRB, post year end, will give you the evidence of the value existing as at year end. Okay. A2, accounting records and assets inspection. Assets inspection. Assets inspection will also let you think of the procedure. Counting records. Okay. Counting records. Simple. Okay. The disclosures. Has it been properly disclosed? D2, directors. And within directors, there are two things: directors' representation and directors' discussion in BOD minutes. And D for docs as well, documents. So D for directors and D for documents. Directors' representation, BOD minutes. And 3 for third party confirmation. Here you can also think of the confirmation. So both these two lists go hand in hand. Getting? As I told you, testing and evidence are not two different things. Few examples of audit procedures, you should go on your own. But let us discuss few we discussed yesterday. For example, development cost. For a sample of costs included in the breakdown, take the breakdown, and then for a sample of costs included breakdown, agree. What you're doing, you're agreeing, you're matching. On what you are matching, the amounts to invoices and timesheets. You are agreeing the amounts of the working with the invoices, with the timesheets. These are the source elements. And why are you doing so? To confirm accuracy. So see, all these three elements. Okay, that's very simple. Directors representation means management representations. The working directors. Okay. Okay. So you might have been confused. Number one is BOD minutes, and B for representation. These are from working directors. Okay. Obviously, from the management representations. Okay. Is it clear now? Michael, is it clear now? Management written representation. Because at the end of the audit, you take the written representation. That's very important. That whatever the management has told you, whatever the management has given you, the all the data, all the evidences, it's perfect to the best of their knowledge. Then you take the representation, and it's a very important audit evidence. Okay. Inspect board minutes. What you're doing, you are inspecting. What you are inspecting board minutes. Why you are inspecting? For any discussion related to the intended sale or use of the asset. 3 elements: action, source, purpose, action, source, purpose, action, source, purpose. Okay. Goodwill. Okay. What you do? You review the legal document pertaining to acquisition to confirm that figures included in the goodwill calculation relating to consideration paid, payable are accurate and complete. Comprehensive procedure. And using the purchase documentation, what you do? You use the purchase documentation and then you confirm the level of shareholding, whatever you confirm, whatever you match, whatever you vouch, you'll write it. Then you agree, you match. What you match? The cash consideration paid to bank statement and cash book of acquiring company. Accuracy of consideration. Okay. Then you review, read, inspect, whatever verb you want to use, you can use the board minutes. And why are you reading the board minutes? For discussion relating to the acquisition and for relevant minute of board of approval. whether the approval exists, what was the reason behind the acquisition. So I hope I have made my point that action, source, and purpose, all three things are very important. So you can go through these procedures on your own. Okay. Okay. See, for revenue recognition, let's read few. Review contract with the customer to obtain. First of all, review the contract with the customer for any revenue to be recognized and obtain an understanding what is the performance obligation and how they are filled over time or at a point in time. About transaction price, is it fixed or variable? First of all, take the confirmation, take the agreement with the customers, and then read these elements. Then inspect what you are inspecting, supporting documentation. Why you are doing so? To confirm when the performance obligations have been fulfilled. Dispatch notes, stage payments made, significant milestones reached. Okay. And for any payments made by customers which cannot be recognized as revenue, confirm they have been recognized as contract liabilities. Payments vouching from bank statements and cash books, simple. Recalculation or calculation of the amount of revenue to be recognized as at year end and agree to the profit and loss for accuracy of the revenue. Are you getting this? Is this crystal clear to everyone? Please confirm me, dear students. Dear students, can you please confirm me? Is it crystal clear to everyone? Great. Then we have group audit. What is group audit? Obviously, you have done consolidation in SBR. Wherever there is parent subsidiary relationship, even in associates, the group. But when we talk about groups, we usually only talk about the parent company subsidiary company relationship where the numbers are being consolidated. Even in associate, we do associate accounting based on IAS 28. But whenever there is a parent subsidiary relationship, whenever there is a control established, control is established. Okay. Then we consolidate the numbers. And there are two sets of financial statements, a standalone and a consolidated. And in consolidated financial statements, the numbers of subsidiaries are also merged. Okay. In balance sheet, it's a line by line addition of assets liabilities. In P&L, again, is line by line addition of the revenues and expenses. Obviously, time prorated. If it's a mid-year acquisition, time prorated. Okay. So the point is, in group audit, you are not only auditing standalone financial statements, you are also auditing consolidated financials. And in consolidated financials, the numbers of subsidiaries are also involved. So can there be problems in those numbers of subsidiary? Yes. There could be multiple problems. Okay. So in addition to the normal, okay, so there are acceptance related considerations. So acceptance related, when you should be accepting a component auditors, they should be obviously competent. They should be cooperating because you need to coordinate with those. So these are few aspects which are very straightforward, easy, so you can go on your own. Acceptance is a component auditor, theoretical aspects. In a group audit, there will be parent financials, subsidiary financials, and consolidated financials. Okay. Issues relating to a new acquisition. So, what are the usual issues? Relationship. If there's a control, subsidiary. Shared control, it's a joint venture. No control, but a significant influence. Power to participate, not controlling, but to participate in decision making. Associate. No influence, it's a trade investment. Shares held fair value through P&L or OCI. Goodwill. Wherever there will be a control, there will be goodwill. Goodwill will be calculated at acquisition, you know very well. And at the year end, we will also see whether it's impaired or not. So look out for the impairment as at year end or not. Whether it's impaired or not, obviously. You have to look over every year. Okay. Date of acquisition is particularly important because obviously from that date, we'll be consolidating the reserves also. Consolidation adjustments. There are multiple consolidation adjustments. When you perform consolidation, there are multiple adjustments. So whenever a group scenario comes in, it's not very difficult. In fact, it gets easier because there are certain adjustments which the examiner asks again and again. Either the consolidation adjustments are not inquired or are not tested. It's a simple question. Group related. There are a few elements of group which are tested, for example, goodwill impairment. Otherwise, all the elements remain the same. All the risks are normal. But there have been few questions in past where the examiner tested consolidation adjustments related risks. So they're very easy. They're very easy. Examiner will not be asking you to consolidate the financials. You will simply be required to throw the risks relating to consolidation adjustments. And these are the common risks which may be there in the question. If the examiner is interested in throwing risks or asking risks relating to the consolidation process, these will be the common risks. Intercompany transactions. So what will be the risk? That intercompany transactions might not have been accounted for properly. Getting this? One entity has booked the sale, the other has not booked the purchases and things like that. So what is the risk? Their intercompany transactions might not have been properly accounted in either books. This is the risk. Another risks. The element of profits in the intercompany transactions might not have been eliminated. So see, items in transit, one, other intercompany transaction item, element of unrealized profit, element of intercompany profit. Okay, because you have to eliminate unrealized profits. Okay, so unrealized profit should have been eliminated. What is the risk? That this has not been done. So it's very simple. What is the risk? That this has not been done. This is the risk. If different year end, the year end should be coterminous or within 3 months of each other. If the difference is more than 3 months, then you have to do interim closing, full closing. Okay. Different accounting policies. You have to make adjustments to bridge these differences. Relevant entries might not have been made. Changes in the group structure, those changes may not have been accounted for properly. This is the risk. Impairment to investment and goodwill impairment might not have been booked. Impairment testing might not have been done. Goodwill has not been impaired. Subsidiary is loss making. This is a clear indication of impairment. Even if there is no indication of impairment, then still you are required to assess the goodwill for impairment at the year end. And the management is not assessing it. And if the management is assessing, the management is not taking account of the loss which the subsidiary is incurring. Okay. There could be an overseas subsidiary. If it's an overseas subsidiary, the foreign currency consolidation elements also pop in. Okay. Then that subsidiary is in a different jurisdiction that might be making the set of financial statements based on the local national accounting standards. Different accounting standards, different currency, language problem, geographical location problem. So these are all the problems which will be creating risks. So you will simply say, there is a risk. There is a risk that relevant adjustments relating to the foreign currency consolidation might have not have been accounted for. Simple. Issues relating to disposal, there might be disposals, mid-year disposals. Has subsidiary 100% gone? Complete disposal? Or now is it a smaller subsidiary? Earlier we were having 90% holding. Now we are having 60% holding. It's a smaller subsidiary. Now become associate. Or now simply a trade investment. Accounted for properly as per the relevant accounting standards. That's it. Gain or loss on disposal should be accounted for, should be calculated properly. Whatever the elements are in the gain and loss of disposal. Tax on gain should be accounted for properly. Date control lost. Now we shouldn't be consolidating it. Plus, if the subsidiary represents a separate major line of business or a geographical location, counted for IFRS 5, discontinued operations. Okay. Other consideration, how big is an acquisition? Materiality, is the subsidiary material? Different firms are auditing, part of the group, joint audits. Are there intercompany guarantees and loans involved? If yes, they should be disclosed. If they're not disclosed, that's a problem. Subsequent events. Is the subsidiary disposed subsequent to the year end? You should disclose. That's a requirement of the standard. If not disclosed, that's a risk. Okay. So we have discussed most of these. Okay. Now, coming on to matters and evidence question. Mhm. Now, this is again one of the frequently asked questions in the examination. Matter and evidence question. Now, what is this type of questions? What is this? What is this type of question? Matter and evidence question. Okay. The question comes up in the examination. The question is asked in the examination. What are the matters to consider and evidence you expect in the audit file? So we discussed about the evidence you expect in the audit file. We discussed those. Now here we are discussing matters to consider. Okay. Point number one, very important point. Which stage of the audit are we in? That's particularly important. Be very focused on what I'm trying to say. At this stage, when we are gathering evidences, when we are performing audit procedures, which stage of audit is this? Is it the planning phase? I need your answers. Is it the planning phase? When we are gathering evidence, when we are testing the transactions, when we are gathering the evidence, when we are looking at the evidence, is it the planning phase or the next phase, testing phase? Need your answers. I hope I'm clearly audible to everyone. Curly rightly said, this is a testing phase. Testing phase. Testing phase. This is not the risk assessment phase. This is not the planning phase. We have planned earlier. Now we are testing the transactions. And now we are out of that risk assessment phase. Although the standards say the risk assessment should continue throughout the engagement, that's a separate discussion. But now we are actually testing the transactions. So earlier we were identifying the audit risk. And the language we were using was there may be a risk, there is a risk. We were showing our apprehension. We were showing the probability. We were discussing the probability of things going wrong. See, understand the major difference. At the first phase, we were discussing the apprehension. We were discussing the probability that the value of financial statements may be wrong. May be wrong. We don't know. May be wrong. We are having an apprehension. Why you are having an apprehension? Because we calculated the ratio differences, and this year the value is exceptionally high. So we have a feeling that there might be some problem. Is there really a problem or not? We are not sure. Symptoms are showing, symptoms are depicting that there may be something wrong. Okay. So what are you trying to do? What are you going to do? We will going to test the financial instruments. We will perform audit procedures. We will check the evaluation working. We will check correspond we will check their existence. We'll check its completeness. We'll check its valuation. We'll perform the procedures. And then we will make sure, then we will be sure, then we will ensure ourselves that financial statements are correctly recognized, true and fair. Okay. So you will move to testing phase. Yes. Now you are testing it. You are testing it. You are testing it. You are testing it. So that means whatever you are testing is as per the risk. Yes. But now after testing, you will actually find out whether there is a problem or not. Are you getting my point? Is everyone getting my point? Please acknowledge me so that I can know that you are at the same wavelength, because your students tend to struggle in understanding this process. This is the testing phase. If you are talking about the testing phase, if you're talking about the testing phase, it simply means that we have performed the procedure and now we are pretty sure whether the problem exists or not. Okay. So in this phase, we have established whether there is a problem or not. Earlier in the risk assessment phase, we were not sure, but we were throwing our apprehension. We were showing our probability. This may be wrong, but now we know whether this is wrong or not. Suppose it comes out to be wrong. For example, the valuation of the financial statements comes out to be wrong, misstated. The approach to draft the problems, the approach to draft the answer will not change much. Why I'm saying this? See this technique. Matters to consider which area is misstated. Have we seen this earlier? Yes, an audit risk. Here we also need to tell the area. Simple. Calculate and assess materiality. Have you worked it out earlier? Yes, during risk assessment. Same. Identify relevant accounting rules. Have you looked at somewhere else? Yes, during risk assessment. Apply the above rules. Same methodology. So what has changed? Stage has changed. What has changed? Our apprehension has changed to certainty. That's it. We will not be using the words there is a risk. We will not be using the words it may be wrong. Now we know whether it is wrong or not, whether it is misstated or not. Now we are very sure about. Are you getting this? So all these four steps are as it is, but we will need to modify our wordings. We will not say there is a risk because now we know this is wrong. This is misstated. This is misstated. So when you say it is misstated and the client has done it wrong, you need to assess its impact on the opinion. Assess the impact on audit report. Now that's our next discussion. That's our upcoming discussion. Impact on audit report. If the client has done it wrong, what is the impact on audit report? And if the client is asked about the procedures or evidence, obviously we already discussed the procedures and evidence. And if in the question you are given any information about that the evidence has not been gathered properly or procedures has not been performed properly, then obviously you will also comment on those aspects or elements given in the question. Matters and evidence question, and 1 mark for properly explained matter. Every matter properly explained, you will get 1 mark. Are you getting this? Is this crystal clear to everyone? Please let me know. Please confirm your understanding. Dear students, matters and evidence question. Matters and evidence. 1 mark for every matter explained in detail. Explained in detail. You'll get 1 mark. Here, the stage has changed. Technique has not changed. The stage has changed. Okay. And after this, we will move on to the audit completion, opinion making stage. Opinion making stage. So if this is crystal clear to everyone, please let me know. I'm waiting your acknowledgements, dear students. Awaiting your acknowledgements. I'm asking whether this discussion is crystal clear or not. Do you have any questions or clear so that we can move on? Great. Great. So we'll be taking a short break. And after that break, we will be continuing our discussion as we will now move on to the next topic, audit reporting. Audit reporting. Okay. So impact on audit report, if the things are materially wrong, if things are wrong, if there's a misstatement, if there's any other problem, we will be having its impact on our audit report. And how we will see the impact, how we will incorporate the impact in the audit report, that's our next discussion, which we will be discussing just after this break. 5 to 10 minutes break, and then we'll be resuming. Okay? Curly. We'll try to make things crystal clear. Don't worry about that. Okay? Dear students, welcome back. Can you please confirm me? Am I visible? My screen is visible, and my pointer is also visible, which is hovering around the screen. Perfect. Okay. So now we are talking about another very, very important learning objective, uh, completion review and reporting. Okay. Why we say the completion phase? Because you've tested things up. First of all, we've planned well, target the problematic areas. Then we've performed audit procedures and audit evidence. We have gathered audit evidences, we performed audit procedures, done a lot of testing, and have actually identified what the problem is. If that problem is material and is not being resolved, then we have no other option but to communicate the problem to the shareholders. How do we communicate? How do we communicate various problems to shareholders? That's the discussion here in completion review and reporting phase. Okay. So we will be discussing major aspects in our discussion in these slides. Okay. How is this area examined? How the question comes up in your exams? In your exams, you will see a scenario. You will see a scenario. Problems coming in and the problems unresolved. And you will be asked to give its impact, to mention its impact, to identify its impact on the audit report. Simple, straightforward. Or examiner can give you an extract of the audit report, and you may be requested or you may be asked to criticize that audit report. Criticize the what? Criticize, obviously. Critical appraisal means there will be problems in that report. That report might contain wrong elements, might contain wrong sequence, wrong contents, wrong conclusion. And you, being a professional student, will be required to identify those problems. Not a big deal. The structure of the audit report. Let's first discuss the structure. Firstly, we'll be having a title, audit report to the shareholders of the company, addressee, intended recipient of the report, shareholders of the company, auditor's opinion. Then we'll be giving our opinion. What is our opinion? Provides the auditor opinion, conclusion as to whether the or not the financials give a true and fair view. Then we'll give basis for opinion. If there is some hanky panky in the opinion, for example, the opinion is not clean, there is some problem, and we say that the financial statements, except for this area, the financial statements give true and fair view. Or if we say the financial statement does not give true and fair view, then why are we saying this? This basis for opinion para will tell why are we saying this. Suppose it's a qualified opinion, then we write here heading qualified opinion. Okay, the heading should represent which type of opinion is this. Suppose if it's a basis for qualified opinion, then we will say basis for qualified opinion, basis for adverse opinion. Okay. Okay. Then material uncertainty related to going concern, if applicable. We will discuss about this. If there is material uncertainty relating to going concern, now what is this thing? What is this phenomena? We'll discuss this. Emphasis of matter, if applicable. If applicable means it's not compulsory that these will be part of audit report. These will be used if and when applicable. Listed entities key audit matters. Now, this para is compulsory for listed entities. Can this be given for non-listed entities? Yes, it can be given, but it's not must. It's not compulsory. Compulsory for listed entities. Okay. Other information. Again, this other information para is also for listed companies annual report. We will discuss why this is given, why is it important. Responsibilities of management, very important. Auditor's responsibilities, very important. Report on other legal or regulatory requirements if required. If there are any additional reporting responsibilities, you may highlight those here. Any other matter para, any other thing relating to auditor's responsibilities or any other thing which the auditor needs to mention, other matter para is there to have his say documented. Signature, auditor's address, date, things like that. Okay. Okay. So this is this simple structure. First of all, I'll move to this slide. Opinion outcomes. Opinion outcomes. Okay. There are five opinion outcomes. How many? Five. Number one, the first one, everyone should be very attentive because this is not going to take much time. But as far as the clarity of concepts is concerned, this is particularly important that you listen to this very carefully. Potential outcomes of an audit report. Five outcomes. Outcome number one, clean opinion, unmodified opinion, unmodified opinion, unmodified opinion, unmodified opinion. When we say the opinion is unmodified opinion, it simply means that opinion is clear that financial statements presents true and fair review. There is no hanky panky in the opinion in the final verdict. The final verdict is clean. But this is not the case always. If there is a problem in the financial statements, we need to modify our opinion. Modified opinion. How many shapes or forms can this modified opinion take? The modified opinion can take four shapes, four forms. And in all these cases, we will say that opinion is modified. Simple. Case number one. Okay. Two cases relates to misstatements and two cases relates to lack of evidence. Two cases relates to misstatements and two cases relate to lack of evidence. Now, when I say two cases relate to misstatement, it simply means that there has been some misstatement. There has been some misstatement in figures. There has been some problem in disclosures. There has been some problem in classification. We have checked it, we have tested it, and we are 100% sure that this is a misstatement. This is wrong. We have tested it, we have gathered the evidence, we know there is a problem, and we know this is wrong. This is called misstatement. Modification on account of misstatement. What's the other scenario? Lack of evidence. Lack of evidence. What do you mean by lack of evidence? There is no evidence to test, there is no evidence to check. We are unable to check, we are unable to test. If there have been evidence, had there been any evidence, had there been any evidence, had there been any evidence, we might have checked it. And it might have been right, or it might have been wrong. It might have been correct, true and fair, or it might have been misstated. But since we don't have an evidence, there's lack of evidence, so we cannot give our verdict. These two situations. So, first of all, please acknowledge me whether these two situations are clear or not. Then I will further move on. These two situations, are these two situations clear to you or not? Misstatement, lack of evidence. Everyone? Perfect. Now, within the misstatement situation, misstatement and lack of evidence, two cases. Within the case of misstatement, there can be two sub situations. What are those? Okay, we know there is a misstatement, we know there is a problem, we know there is some hanky panky in the numbers, and we have checked it, we have tested it, we are now sure. Is it material only? Is it material only? Is it material only? Or is it material and pervasive? Is it material only or is it pervasive? Is it material only? Or is it pervasive? What do I mean by this? If it is material only, it means it is material. We cannot ignore it. It is material for the decision making of the users. We should tell them. But the problem is limited, confined to any one or two areas of the financial statements. Limited. In simple words, there is a cancer patient, God forbid, and the problem of cancer, the germ of cancer is limited to one organ. Are you getting this? And by treating that organ, or by cutting off that organ, or by identifying that organ, we can say, except this organ, the entire body of this human being is perfectly fine. Only this organ has an issue, and this is an issue. Case number two. Is it pervasive? No, it's pervasive. Pervasive. Pervasive means the problem is not confined. The problem has spread in the entire financial statements. Either the problem has been spread in the entire financial statement, or the problem, or even if the problem is in one area, the problem is too big that it has taken over the majority chunk. For example, the cancer has spread in the entire body, God forbid, unfortunately. Then we'll say the entire body is affected from this disease. Entire body is affected. But if entire body is not affected, such major chunk is affected. For example, the brain is infected. The brain is the CPU of human being. If brain is affected from any disease, any deadly disease, we will say he's gone. He's gone. Major chunk is gone. God forbid, unfortunately. This is the case with the financial statements as well. If the problem is confined to limited area, for example, inventory is misstated. We have tested inventory is not measured at lower of cost or NRV. Problem lies in inventory. It is misstated. The inventory is misstated by $2 million. Profit is up by $2 million, and think dot dot dot. Inventory is wrong. All other elements are fine. Assets have not been tested for impairment. Assets seem to be impaired by this much amount. Dot dot dot. Material. Pervasive. Pervasive. We will not say that this area is misstated, this area is misstated. We will say entire financials does not present true and fair view, does not present true and fair view. So see here, if it's material, we will say except for this area, everything is okay. If it's pervasive, we will say does not give true and fair view. Is this clear or not? Is this clear or not? Then I'll move on. Please confirm me. Misstatement portion clear to everyone? Everyone need your acknowledgement? Okay, lack of evidence. What do you mean lack of evidence? Lack of evidence simply means that management has not given us the relevant evidence. We could not count inventory. We don't have evidence. We cannot see inventory. Management is restricting us. We don't know. We have been restricted to the inventory area. We don't know whether it is right or wrong. Our scope has been limited. We don't have any evidence. So we will say, except for the inventory which we have not seen, which there for which there was no evidence, except for this inventory, everything else presents true and fair view. Simple. Except for inventory, everything else presents true and fair view. But if the restriction, if the lack of evidence is so deadly, is so major, is so big, is so deadly, is so major, is so big that we are unable to form opinion on majority of the financial statements, then we'll raise our hands and we'll say we cannot give an opinion. That's the fourth outcome. Simple as easy as that. Now let's look at further. When we say pervasive, when we say pervasive, we mean fundamental to the financial statement. Anything problematic which is very fundamental to the financial statements, rendering the entire financial statement wrong. Are you getting this? And whenever you modify the opinion, explain the modification in the basis of opinion. We've already discussed this. So when a matter is considered pervasive, so there are few cases, few examples. When effects are not confined to specific elements, spread, the cancer is spread in the entire body. These statements are spread everywhere. And if so, confined represents a substantial portion of the financial statements. Disease in brain affected, entire body gone. For example, misstatement is in assets, and assets represent 90% of the balance sheet. Substantial. In relation to the disclosure, the are fundamentals to users' understanding of the financial statements. Very fundamental disclosures. We will see when we'll discuss going concern. We'll see how, why, when. This will mean the financial statements do not give true and fair view. Examples: preparation of the financial statements on wrong basis. We'll discuss it further. Wrong basis. When the financial statements are required to be prepared on realizable value basis, those are prepared on going concern basis. Wrong basis. So the basis used is wrong, which means the entire financial statements are wrong. Non-consolidation of a subsidiary. Subsidiary has not been consolidated. Big issue, big problem. Every number in financial statement is misstated. Material misstatement of a balance which represent substantial portion of the asset, or if it changes profit to a loss. If profit could be changed to loss, that means the entire investor focus may be shifted. That's a substantive thing. That's a pervasive thing. Okay. That's a pervasive misstatement. even it is if monetarily not very big, but the misstatement, which is changing profit to a loss or loss to a profit, that's pervasive. Disclaimer. A disclaimer is issued when the auditor has not obtained sufficient appropriate audit evidence. Auditor does not express the opinion. Like, what would be the examples? Failure by the client to keep adequate accounting records. No accounting records could be found. No adequate accounting records could be found. So, what auditor is supposed to check? Refusal by directors to provide written representation. Now, that's a big thing. Directors are not providing written representation. They are not acknowledging their statements made during the audit. They are not owning the evidences provided during the audit. They themselves are not concerned. They themselves are not confirmed. So, how can we sign the audit report when the management is not confirmed on their data? Written representation is such a big thing that if they refuse to sign it, we'll give disclaimer. Failure by the clients to provide evidence on a single balance which represents a substantive portion. So we don't get evidence on assets, which is 90% of the total balance sheet, gone. Okay, so everyone, please acknowledge me. 4 modifications, crystal clear or not? Any question, please do ask, or we'll move forward. Any question, please ask. Any question, please ask. Anyone? Great. Okay, now I'm moving towards the discussion of CAM, which confuses the students a bit. Okay. Key audit matter. Key audit matter. What is a key audit matter? Is it the matter of misstatement? Are we supposed are we supposed to communicate misstatements in this para to the shareholders of a listed company? Because this is compulsory para in a listed annual report. Are we supposed to communicate? Are we supposed to communicate misstatements to the shareholders of a listed company? Answer is no. We are not supposed to communicate misstatements in this para. Okay. Then what are we supposed to communicate? Key audit matter. Focus on the name. Key audit matter. Audit. So, any matter which is key from audit perspective, which means that being auditor, we were more concerned about any particular area. We were more concerned about any particular problem. And during audit, we tried to address it to the maximum extent. We tested it. We designed procedures to attack it. And it was fine all over. But yes, We initially felt that it is a potentially problematic area. There could be any time bomb within this area. But fortunately, there was not. Or the procedures, whatever we performed, didn't identify any misstatement. So these were those potentially problematic area, which we focused more during our audit because these were of audit importance. And usually, what the common sense says that these will be those areas which are the audit risks, which are the major audit risks, which are the major significant audit risks on which we channelize our efforts, on which we devoted our time, on which we devoted our uh, resources, on which we assigned our senior staff, on which we performed lots of procedures. Those are the key audit matters. And we are going to communicate these key audit matters to the shareholders. Are these matters relevant for their decision making? I'm not saying this. These might not be relevant for shareholders' decision making, but I am trying to show my efficiency that how much I have done on the problematic area because I felt these might be wrong. I felt there could be any problem in those areas. So I have devoted more time and effort on those areas. For example, the valuation of financial instruments. I suspected there could be overvaluation. I suspected there could be wrong valuation. I suspected there could be some calculation problem. So I tested it in detail. Impairment of assets. I thought that there might be risk of impairment. I thought the entity might not have performed impairment testing properly. I tested it. I tested it in detail, but there was no issue. Everything was okay. Everything was fine. So now I am communicating what I've done on problematic areas. Is everyone getting this? So key audit matters are those that in auditors' professional judgment were of most significance in the audit and are selected from matters communicated to those charged with governance. And I give you another hint and indication that these are those matters which are audit risks. And we communicate the audit risks to those charged with governance as well. Okay. The purpose of including these matters is to assist users in understanding the entity. This will not help them in any of their material decision making. Yes, this will help them in understanding what could be the problematic area for the entity. There could be a potential bomb in that area. Luckily, there is nothing problematic, but this could be an area of concern. And to provide a basis for the users to engage with the management. And what the users can engage with the management and discuss about these problematic areas so that management remains concerned that these areas should be prioritized from all perspectives. Okay. Relating to the financial statements. Examples, what could be the examples of CAM? The risks of material misstatement, and how we addressed those, what we worked, what were the conclusions. And obviously, the conclusions would be positive. If the conclusions have been negative, then obviously those will go in qualifications. Modifications. Example, complicated accounting areas, subjective areas, significant risk of fraud, goodwill, effect of new accounting standard, new IT system. There could be some problems. So potentially problematic areas from auditor's perspective, from my eyes, from my glasses. If there is no CAM to report in a listed company, you should write it in the audit report. There is no CAM to report. You have to discuss this with engagement quality reviewer. You have to communicate to audit committee and you have to communicate this in CAM para as well. Is this crystal clear to you? CAM para, CAM. Everyone? Usually CAM para is confused with another para. Which para? Emphasis of matter para. Students usually ask, what will go in emphasis of matter para and what will go in can para? Okay. Emphasis of matter para is such a para in which the auditor will emphasize any matter which is fundamental to users' understanding of the financial statement, fundamental to users' decision making, fundamentals to shareholders' decision making, fundamentals to shareholders' understanding of the financial statements. Can. In the earlier format, there was no section for can. So auditors earlier were not reporting can. It simply means that CAM is such an area which, if not communicated to shareholders, will not make much difference because this is the area of audit significance, key audit matter. If not told to shareholders, not a big deal. But emphasis of matter para is any matter, any problem, any event which the auditor feels that this is important for users' understanding of the financial statement. Without this emphasis, without this extra prioritization, it might not be possible for the shareholders to understand these financial statements properly, or might not enable shareholders to take decisions which they ought to take in the light of the available information. Are you getting this? For example, any other very important matter, which is correctly included in the financials. Financials are properly okay, perfectly fine. And this matter is included in the financials, but we wish to emphasize that, dear shareholders, open your eyes, look at this, look at this, look at this. This is something important for you. This is something important for you. Everything is okay. Everything is right. Our opinion is also gives true and fair. We are giving true and fair opinion. We are not changing our opinion. We are not modifying our opinion. But we give an extra para. But we give an extra para. But we give an extra para. If needed, not always. If needed, not always. Okay. Auditor adds para to tell shareholders to read this note that matters of fundamental importance to shareholders. Example of such matters are if the financial statements have been prepared on a basis other than going concern, if any basis other than going concern is used, other than going concern, if any basis other than going concern is used, that means break a parallel basis. Okay. Any uncertainty relating to future outcome of exceptional litigation, any big case going on, and there is uncertainty, what decision will it be? It might be a decision against the company, which may be relevant to the shareholders' understanding. Currently, nothing problematic with the financial statement, but this is such a big case. It may be decided in favor of the company, it could be decided against the company, but shareholders should have the information of this case. Any significant subsequent event, for example, unfortunately, God forbid, suppose if there's a fire erupted in the warehouse subsequent to the year, subsequent to the year, no conditions existed as it year. What will happen? We have to communicate to the shareholders. We have to give disclosure in the financial statements. And if this is very big fire, we may need to give emphasis of matter. This is such a big fire that could incur big losses to the companies. Any early application of new accounting standard, any major catastrophe that has a significant effect on the financial statements of the company. Are you getting this? So emphasis of matter and can. Don't confuse this. Students tend to confuse this. Which matter will go in emphasis, which matter will go in can. So I think this should be crystal clear to you, the difference between these two paras. and CAM goes in the FS of listed company. Okay. So can you please acknowledge that this understanding is crystal clear, everyone? Please let me know. Dear students, can you please confirm me the difference between these two? Very important. Yes, emphasis of matter can be for any company, listed, non-listed for any company. But CAM is must for listed. I'm not saying that you cannot give CAM for non-listed. It is usually not given. But if somebody wishes, can give. But must for listed. EOM, it's not must. It will be there if needed, even in listed or non-listed. Currently, I hope it's clear to you. Any other question, any other concern, please let me know. Clear? Should move on. Because I want to complete the discussion of this completion aspect because when we'll be doing questions, there will be a lot of knowledge required. To this topic, I would wish to have my discussion closed. Okay, right. Okay, as far as the additional paras are concerned, there is another para, material uncertainty relating to going concern. Material uncertainty relating to going concern. Now, what is this para? Okay. Material uncertainty relating to going concern. Now, this is an additional para which is used in a very special situation. What is that situation? There are two terminologies. One terminology is going concern uncertainty. Going concern uncertainty. And the other terminology is going concern inappropriate. Going concern inappropriate. Going concern inappropriate. What does that mean? What does that mean? That simply means I'll give two very simple examples to explain this concept. I'll give two very simple examples to explain this concept. Suppose we all unfortunately passed through the phase of Corona, COVID 19. So let me take an example from that time. Suppose if a COVID suspect, if a person, Mr. A, is a COVID suspect, we don't know whether he is COVID positive or not. He's infected with the coronavirus or not. We don't know. But there are symptoms. He's feeling headache, he's sneezing, coughing, having temperature, having symptoms of coronavirus, COVID 19. Can we say he's COVID positive? No, we cannot say he's COVID positive. Until and unless it's established. How? Through a report, through a test. Till the time it's established, we'll say that there is an uncertainty regarding his health. He may be COVID positive, may not be. Uncertainty. But we are not sure that he is infected or not. Okay. If we are not sure he's infected or not, there are symptoms. So what we'll say, please take precautionary measures. Take precautionary measures. Okay. What are the precautionary measures? Use mask, get yourself isolated, whatever is needed, and let others know that you are having some symptoms. That's uncertainty. So take the measures, take the required measures, take the required measures. If you're taking the required measures, that's perfectly fine. And tell others, tell others, tell others. Okay. What if that patient has been tested and it's established it's COVID positive? We say, no, he should go in isolation, complete boycott, complete isolation, doses, whatever the treatment is. It's established, inappropriate. Getting this? Similar is the case with the company, with an entity. When we say the going concern assumption is appropriate, he's okay. But there is uncertainty. We are not sure. Assumption is appropriate, but there are dark clouds looming around. Dark clouds looming around. Dark clouds. There could be severe thunderstorm, which may damage the entity. What could be the dark clouds? Problems, business problems, cash flow problems, customers going away, loss of revenue, things like that. Dark clouds. But the customer has taken safety precautions. What are those precautions? For example, the customer has the umbrella in his hand, dark cloud, but I have umbrella in my hand. If there is a strong storm, thunderstorm, severe rain, I can save myself through this umbrella. No worries. So how does this fit on company? If there are problems, customers lost, cash flow problems, losses, how can you survive? How will you survive? I can survive. I'll take the loan. The loan is confirmed. Bank has consented to give me a loan. Directors have shown their consent that they will inject additional equity. I have support letter from the parent company. I'll survive. Okay, that means you have an umbrella in your hand. Yeah, you have backup plan. Yeah. Although there are dark clouds, but I'll survive. Yeah. That's uncertainty, but assumptions is still appropriate with the measures. With the measures, still appropriate. But when we say going concern assumption is inappropriate, it's established that entity will not going to continue for foreseeable future. Customer lost, losses, no cash flow, no backup plan, no loan possibility, no parent support letter, nobody is there to help you out. It's almost confirmed that you're going to close your operations. Inappropriate, established, stand, almost. Then we say going concern assumption is inappropriate. Are you getting this? Uncertainty versus inappropriate assumption. Uncertainty versus inappropriate assumption. So, what are we going to do? If there is uncertainty, we say, okay, tell this to the shareholders. If you're having cough, sneeze, temperature, tell this to everyone that you are having these symptoms. And what are the plans in place? You have taken masks. Disclose, disclose the problem. And what are the backup plans? Disclose. If you have disclosed the problem, if you have disclosed the backup plan, sorry. If you have disclosed the problem, if you have backup plan, disclose it. We will don't do anything. Our opinion will be unmodified. We'll give you the clean report. We will say financial statements present true and fair, but we will put an additional section with the name of material uncertainty relating to going concern. And we will explain this fact in this para. This is an additional para. This is the responsibility. We will put it in the report. You don't need to worry. You have given your disclosures, but this is our duty to highlight this fact. That's it. Opinion is not modified, but provided you have given adequate disclosure, you've disclosed this problem. But if you're not disclosing this, you're not disclosing your symptoms. You're coughing, you're sneezing, you're having headache, you are uh, having fever. You're not telling the other guy. So he cannot save himself from you. Problem. You are not disclosing it. So no disclosure. No disclosure to shareholders. Or if there is a disclosure, no, it's not a proper disclosure. The treatment is not adequate. Either you are missing the disclosure or you're not giving proper disclosure. Then we will qualify it. We will change our opinion. Either we will qualify it, or if we being auditors assume that this is a pervasive matter, then we may even give adverse opinion, unfortunately. So you have plans in place, you have backup plan, your going concern is appropriate, but there uncertainty involved. Disclose it properly, will not do anything. We will put a merge para, we'll put only one additional para. We will highlight this matter, but we will not change our opinion. But if you don't do this, if you don't disclose it properly, we will change our opinion. If your going concern assumption is not appropriate, and you have disclosed this, you have done correct treatment, you have prepared your financial statements on realizable value basis, which IAS 1 prescribes you. You have done correct treatment. You have prepared your financial statements on realizable value basis, not on going concern basis. Then, since you have done the correct treatment, we will give unmodified opinion. We will not change our opinion. But we will emphasize this fact, not in merg para, because that's for uncertainty. You are not going through the uncertain phase. The phase is certain, but uncertainty about the inappropriateness. You are not going to continue in the future. So we will put an emphasis of metal para to draw the attention of the shareholders towards this fact. And if you have not given correct, you have not followed correct treatment. If you have not followed correct treatment, then unfortunately you will have no option but to give an adverse opinion because you have not prepared the financials on realizable value basis. Your entire financials are rubbish. You will give adverse opinion. Is this crystal clear to all of you? Please confirm me. Please confirm me. I tried to make it as simple as I could, but still, if you have any problems, confusions, or concerns, please let me know. Everyone, awaiting your acknowledgement. Okay, perfectly fine. Yes, I'll be sharing these slides. Don't worry. Okay. So material Merck para, what we do in Merck para, we mention the going concern threat. And if the client correctly discloses in the financial statement, we give this para. If the client have correctly disclosed in the financial statements, we simply refer that, emphasize that our opinion is not affected. And we tell shareholders that which financial statement note to read. Just go read that note. Yes, I'll share it on WhatsApp. No worries. Okay. Emphasis of matter done. Unmodified opinion. But extra para, another extra para is other info, other info, other info, other info. What is that? We know that now the listed entities issue the annual report. The annual report is a thick booklet. It doesn't only contain financial statements, it contains several other documents. But we, being auditors, are only auditing financial statements. We are not concerned with other reports, environmental reports, chairman review, director review, other things. That booklet of annual report contains lots of data. So, are we responsible for every other content in the annual report? Answer is no. Because we have only audited the financial statements, profit and loss, statement of financial position, cash flows, statement of changes in equity, notes to the financial statements. That's it. And our opinion is based on the set of financial statements. But the standards say that since this annual report contained the other documents, so the shareholders may have this impression that your report covers all documents. So what are you supposed to do in case of listed companies? Give a para by the name of other info. And in this para, make this clear that our opinion is on the financial statements. And we have not audited other info. But the standards say that you have to at least read the other info. At least read other info. Why are we reading other info? When we are making it clear that we have not audited this info, then why are we even reading it? Very simple. Because if that other info contains any information which is contradicting with the financial statements, then users may get confused. Number one. Number two, this problem may reduce the credibility of your opinion, may reduce the credibility of financial statements. So there will be a clear cut mismatch. Chairman review might be saying that we have done great profits this year, our divisions are performing wonderfully well, but in actual, the financial statement is showing that revenue has decreased. There is a clear cut contradiction. Shareholders will say, what rubbish is this? There is a contradiction in two things. Don't you think that although the chairman's review is a separate document, you don't have any say in that document, but still, that inconsistency is reducing the credibility of the financial statements. So in other info, okay, examples of other info include chairman's report, operating and financial review, social environmental reports, corporate governance. So if the auditor identifies a material inconsistency, if the auditor identifies the inconsistency, what they should do, they should perform limited procedures to evaluate the inconsistency, whether financials are wrong or other info is wrong. If the financials are wrong, get it rectified. If the management is not rectifying it, change the opinion. If other info is wrong, ask management to rectify. If they're not rectifying, mention in other info that this is inconsistency and management is not rectifying it. Getting? And if the management is not rectifying it, that means the management is not honest. They have some dirty intentions. So if the law allows, after taking legal opinion, in severe circumstances, in extreme circumstances, auditor may even consider withdrawal if possible. What is other matter? Anything else auditor wants to say can be said in other matter related with responsibilities or any other thing. You can read it on your own. Okay. Then we have exam techniques. Okay. Exam techniques for criticizing the audit report. We will discuss the exam techniques and we'll close the session. Discuss a lot of things today. And tomorrow we will start with the practice of a past exam question and we will try to do multiple questions tomorrow. Unfortunately, we couldn't do any question today because we had discussions left. As far as the non-audit assignments are left, we will discuss the non-audit assignments with the questions. Whenever the question will come up, we'll talk about that non-audit assignment and we'll do the question. So don't worry about that. Okay. As far as the technique is concerned, appraising the audit report, critically appraising the audit report. Examiner will give you a report and there will be some problems in that. The outcome might not be correct. The modifications and extra paras might not have been properly used. Contents might not be in correct order. So you need to identify opinion para should be above the basis for opinion. If listed, there should be CAM and other info para. Titles are not correctly mentioned. Clarity is not there. The shareholders might not understand. Written IFRS, not given full title, International Accounting Standards. Evidence is missing and not told which evidence is missing and why you are unable to find out this evidence. You have mentioned about the extract given in the question talks about misstatement, but it doesn't quantify the impact. It does not give the reason for modification. It's the problem. Professionalism is lacking. Slangs have been used in the report. Directors have been accused. They have done the mess. Not allowed. Such wordings have been used which are undermining the credibility of audit opinion. Auditor feels, we feel, it may be. No such wordings allowed. So all these wrong ones will be there in the wrong audit report, and you will be required to identify these and rectify these. So we will see the question. Implication. The other type of question is about the implication of audit report. And the implication question is not a big deal. We discussed the matters to be considered, technique, materiality, counting standard, application, materiality, accounting standard, application, and one element which I'm missing. Yeah, area, materiality, financial statement area which is affected, relevant accounting standard, its implication, is it significant or not? And as far as the opinion is concerned, is it material or pervasive? That's it. Which type of para will be used? Simple. Same pattern will be followed, plus the type of opinion or type of additional para which is required in that situation. Are you getting this? So this technique is not a big deal. We will practice the technique tomorrow. So let's keep the session till here. And we will start with the question tomorrow and we'll target past exam paper of not the last one, paper before the last one. Okay. We will target the latest attempt past exam papers, latest 3-4 attempts past exam papers, and we'll see how the techniques are applied and how our knowledge works on those questions. So we will pick up the questions from last 2, 3 attempts. Okay. So this is for you. So see you all tomorrow with few practice questions when we'll be applying our knowledge, whatever we have discussed, whatever the techniques we have discussed, so that things get easier for you in exams. Okay. If you have any questions, if you have any comments, if you have any concerns, please let me know. Or should I close the session? Please let me know, everyone. Dear students, can you please confirm me? Let me know if you have any queries. Okay, tomorrow. Okay, tomorrow time will be 6:30. But if there will be any change, I'll communicate it. Okay, time is 6:30 p.m. PST. But if there will be any change on account of any commitment, I'll communicate it. Okay. Thank you very much. May Almighty bless you all. Take care a lot. Wishing you very best of luck for your preparation. See you soon. See you tomorrow with some practice questions. Take care a lot. Bye bye.